Mining is a constant battle against depletion. Every ounce pulled from the ground is an asset permanently erased from the balance sheet. To survive over the long term, producers have to build a relentless cycle. They must extract value today to fund the discovery and acquisition of tomorrow's reserves. Look at Agnico Eagle Mines. This senior gold producer provides a masterclass in how to manage this exact corporate lifecycle. In the second quarter of 2026, the company reported $1.335 billion in free cash flow, pushing their net cash position north of $3.2 billion. We are going to map that quarter of data onto a cyclical system model. By tracking capital from extraction to depletion to asset replacement, we can see exactly how a senior producer uses cash to buffer risks and secure future growth. Evaluating a mining major through this continuous feedback loop separates a standard earnings recap from actual strategic financial analysis. The first phase of this loop relies entirely on operational execution, the cash harvesting engine. During the second quarter, Agnico Eagle's operations outperformed their own budget expectations, pulling 855,816 ounces of gold out of the ground. Those high production volumes hit the market at precisely the right time, intersecting with a strong macroeconomic tailwind of elevated realized gold prices. Management compounded that revenue advantage by maintaining strict operational discipline, driving costs down below the midpoint of their internal guidance. This waterfall chart breaks down the financial result. Starting with that gross production volume, stepping down through costs and operating margins, we land on a massive adjusted net income of $1.541 billion. For shareholders, that translates directly to $3.07 per share in a single quarter. But the metric that dictates corporate strategy is this final block. The company generated a record-breaking $1.335 billion in free cash flow. Generating that level of cash completely distorts a company's balance sheet compared to its peers in the industry. Look at this comparative chart. On the left, we have Agnico Eagle's total debt, sitting at a remarkably low $197 million. Now contrast that with their cash balance. With $3.464 billion in cash, the company holds a net cash position of over $3.2 billion. That overwhelming liquidity is exactly what prompted Fitch to upgrade Agnico Eagle's credit rating to an A-. Holding over $3 billion in net cash provides immense optionality. In a highly cyclical sector, that capital is a strategic weapon that allows management to dictate their own terms. That capital defense is necessary because of the second node in our loop, the unavoidable reality of physical geological risk. On July 1, 2026, an incident occurred at the Canadian Malartic complex, specifically involving the massive Barnat open pit. A rock mass movement occurred along the north wall of the mine. As a direct consequence, the company took precautionary measures and temporarily suspended mining operations in that specific area. This shutdown forces a localized production hit, removing an estimated 60,000 to 80,000 ounces from their second-half output. To understand the impact, look at this capacity gauge representing the company's full-year aggregate corporate guidance, which sits between 3.3 and 3.5 million ounces of gold. When we subtract that localized 80,000-ounce loss from the massive total, the overall needle barely twitches. The Barnat Pit was scheduled for completion in 2029, and its long-term structural viability remains completely unchanged by this short-term disruption. This is the portfolio effect in action. By diversifying their operations across Canada, Australia, Finland, and Mexico, the company dilutes the mathematical impact of any single localized failure. That math is why institutional analysts at firms like BMO categorized this physical disruption as a relatively minor financial event. Immense operational scale absorbs unpredictable geological events, turning what would be an existential threat for a junior miner into a simple balance sheet rounding error for a senior. Which brings us to the final node of the corporate lifecycle, deploying that shielded capital to solve the inevitable depletion of existing reserves. On August 24th, Agnico Eagle announced a $41.1 million or 57.16 million Canadian dollars in Radisson Mining Resources. The cash is specifically targeted at advancing a high-potential underground exploration program at Radisson's O'Brien Gold Project in Quebec. This chart shows the exact financial mechanics of the non-brokered private placement. Agnico's $57.16 million investment converts directly into 53.42 million units of Radisson. If we deconstruct one of those units, we see it contains one Class A share priced at $1.07, alongside half of a purchase warrant. Each full warrant grants Agnico Eagle a 60-month window to buy an additional share at a fixed strike price of $1.39. Those warrants create asymmetric upside, handing Agnico highly leveraged exposure to a major discovery. Depending on execution, this alters the cap table. Agnico secures a 10.45% non-diluted stake, with the ability to push to 14.90% partially diluted. Agnico leveraged the weight of this capital to secure strict governance covenants alongside their equity position. They secured guaranteed board representation, anti-dilution participation rights for future financings, and tight restrictions on property transactions through the end of 2028. This deal structure illustrates how a major producer utilizes a pristine balance sheet. They acquire maximum strategic control and pipeline replenishment, while taking on minimal upfront capital risk. When we put these three phases together, we see a complete, functioning corporate strategy in motion. Record operational cash flow fills the treasury. That treasury acts as a buffer against geological losses, and surplus capital is systematically deployed to restock reserves. Let's look at how the public equities market values this disciplined execution. At the time of this analysis, Agnico Eagle stock trades at $224.11, pushing near the very top of its 52-week range of nearly $255. Wall Street consensus aligns with this performance. Looking at this ratio graphic, analysts currently maintain 12 strong buy ratings, 0 sells, and average price targets sitting between $214 and $226. That analyst conviction directly stems from the company's ability to fund pipeline growth while simultaneously returning a massive $625 million to shareholders in a single quarter. In an industry defined by uncontrollable macroeconomic pricing and chaotic geology, Agnico Eagle proves that financial discipline is the ultimate control mechanism. This heavily engineered balance sheet functions as an aggressive tool for securing long-term dominance, providing the stability necessary to seize opportunities in the resource sector. Please note, this video is for informational and educational purposes only. It does not constitute financial advice or an offer to buy or sell securities. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions.